The secret's out. There is a massive storm brewing in the commercial real estate space. And as investors, we have to understand the context of all of this. How did this all happen? What's next? And how can we best position ourselves as investors to take advantage of the massive opportunities ahead of us? For those of you who are new to the channel, my name is Danny Gould. I'm the CEO of the Selling Silicon Valley Group. Over the last 8 years, after graduating from Stanford, I grew my residential real estate team here in the Bay Area. We sold well over $200 million. And now on the investment side of things, I'm partnered with a private equity firm that specializes in hotel and apartment acquisition. So that's what I'm currently working on. And that is why this topic is so near and dear to my heart right now. And I have been in the trenches now trying to figure out, number one, how did this all happen? And I think that many of us have heard what is happening, but don't necessarily understand the context and like how this all came about. So that's what I'm currently working on. And that's why I'm making this video, because like a lot of you probably sitting at home right now, you've heard about what's going on. This has been in the news now for quite some time, but we may not understand necessarily how this happened. Like, how could this possibly happen? And how can we best position ourselves to take advantage of this massive opportunity in front of us? Let's get into it. So this all started in 2014 when banks started issuing more interest-only loans than traditional loans. And if you see this graph here, you'll notice that in 2013 and in 2014, we saw a massive surge in interest-only loans. Now, question becomes like, why would we do that? Well, it was around this time that the recovery from 08-09 was really starting to take effect. And at the time, prices were skyrocketing. And to help investors justify buying buildings at inflated prices, this was the result of that. Lenders were forced to get creative with the way that they structured the loans. And by the way, this helped REITs, this helped syndicators, this helped private equity firms, this helped every type of investment group maximize cash flow. When you look at the monthly payments on an interest-only loan versus the monthly payments on a traditional fixed rate loan, the margins are much higher on interest-only loans on a year in and year out basis. The difference is that one, you're paying down principal, the other, you're just paying the interest. And so the waterfall at the end, the equity that you really realize at that point is far less when you are structuring everything as an interest-only loan. So on paper, even though prices were going up, these interest-only loans were helping investors and investment groups justify buying these buildings because the cash flows looked amazing on paper. And if we look at this chart once again, you'll notice that from 2013-14 all the way up until about 12 to 24 months ago, the adoption rate, the amount of loans that were structured as a percentage every single year grew and grew and grew. The biggest issue that I see with all of this is that as time went on and more borrowers were structuring their loans as interest only, that effectively inflated commercial real estate prices even more by suppressing the price of the borrowed money by structuring loans in this way. And by the way, at first glance, this isn't necessarily the worst thing in the world. After all, if we can improve the rate of return on the investment, as long as prices continue to go up, we should be fine, right? Well, not necessarily, because these loans are not at a fixed rate. These interest-only loans are variable, and a lot of these loans are coming due in the next 3 years. And this isn't just a little bit of debt. We're talking about $1.5 trillion of commercial debt is coming due in the next 3 years. And this is according to data collector TREP. Now, if you have a pulse, you're probably very aware about what's happened to interest rates in the last year and a half. But when these loans originated, where were the rates at? They were about half of where they are right now. And so the numbers, they made sense before with the interest rates of yesteryear. But now with the rates where they're at, a lot of these commercial properties that were bought in the last couple of years no longer make financial sense to hold on to. In fact, Fitch Ratings recently estimated that 35% of pooled securitized commercial mortgages coming due between April and December of this year won't be able to refinance. And this is based on current interest rates and the property's incomes and values. In other words, 35% of these variable mortgages that are coming due don't pencil out anymore. The owners can't refinance because the incomes being generated by these properties, the NOI, has not increased as much as the interest rates. And so the values no longer pencil out. In fact, I wouldn't be surprised, and of course I don't have any data to support this, but I wouldn't be surprised if a large percentage of these commercial properties actually had lower NOI NOIs now than they did when the owners first bought the property. And so when the net operating income comes down, what does that do to values? The values come down. And if the rates are going up at the same time, we're refinancing at the new value. Well, we're refinancing at a new value, but the rate's higher. So then all of a sudden, all the margin's gone. And so it no longer makes sense for the seller. Not only that, or rather the owner, but it no longer makes sense for the bank either. And so you have this perfect storm of events that is currently happening right now that has gotten us to this point. MishTalk.com points out that while many malls and hotels face high default risk, the situation is particularly dire for office owners. And this is also very unsurprising. With the surge in work from home activity and remote office and all of that good stuff, we are now seeing a migration away from the office culture that was the 1900s. NicheTalk.com goes on to point out that Xiaojing Li, he's the managing director of the risk analytics team, estimates that as much as 83% of outstanding securitized office loans won't be able to refinance if interest rates stay at the current levels. Yes, 35%. You heard that right. That is bad news. And by the way, the carnage has already begun. According to Forbes.com, Brookfield Corporation, which is one of the largest public real estate companies in the world, has defaulted on $161.4 million worth of office building mortgages. And that comes roughly 2 months after the company defaulted on $784 million in mortgages for 2 Los Angeles office towers. And the hits keep on coming. Just a few days ago, Ashford Hospitality Trust was reported to likely be in a position where they have to hand back the keys on 19 hotels across the country. So the question becomes, what's next? According to Forbes.com, increasing debt default could be a major concern for small and regional banks, which hold roughly 67% of all commercial real estate loans. This is according to the Federal Reserve data. So with that $1.5 trillion in commercial real estate debt that's set to mature over the next couple of years, small banks could face the risk of collapse if a large portion of these debts are defaulted on. And the threat is so real. Back in March, Signature Bank, which is a New York-based bank, collapsed as roughly half of its lending was to commercial real estate. Now, it's important to note that not every default ends with the lender taking the keys. A lot of times property owners can stave off foreclosure by paying off the loan with their own cash or by extending the mortgage or renegotiating the terms of the mortgage. But according to Mish.com, the chair of law firm Morrison Foerster's Global Real Estate Group said he's seeing more lenders take over office buildings than at any point since the early 1990s. That being said, according to therealdeal.com, if there is one bright spot for commercial real estate, it's in the multifamily market. Sentiment towards apartment buildings remain positive as renters stay in the market rather than pursue home ownership, which has become vastly more expensive in the past 3 years. Obviously, this is not a surprise. If you've been paying attention, you will know that the middle class is getting squeezed. And as a result, we are seeing more and more segmentation, the haves and the have-nots. Now, what's interesting to know is that experts are split on the ramifications of this. Some believe that we could see a path towards recovery by late 2024 or 2025. And other experts believe that economic conditions are going to dictate the true impact of all of this. If we experience a true economic recession in the midst of this commercial loan crisis, it could exacerbate the issue and force the economy into a greater tailspin. So what do we do with this information? Well, as owners, the first thing that we need to do is weather the storm. Our job is to weather the storm first and foremost. But as investors, we have to be prepared and we have to be on the lookout for great deals. And there will be great deals out there. For example, one of my mentors, Mike Ely, owns several $100 million worth of apartments and hotels. Recently had a bank assign him the debt on 2 hotels. And just like that, he became an owner of 2 more hotels because the previous owner could no longer pay the mortgage. And instead of foreclose and go through this whole process, they just said, Mike, assume the debt and the property's yours. These are the kinds of deals that are going to be out there if you know where to look. I'd love to hear your take on this in the comments down below. What's your take on the current state of affairs and what are the ramifications of all of this, both in the short term and in the long term? Leave your comments down below. I'd love to hear your thoughts. This is Danny Gould. Thanks so much for watching and I will catch all of you in the next video.